Okay, everyone. The mics are working. Everyone's here. Thank you very much for already being seated. I'd like to start our panel here. So good morning, almost good afternoon to everyone. I'd like to thank everyone for being here for the cleantech panel. I have a great set of panelists here. My name's Steve Spinner. I'll be both the moderator as well as a panelist on this because I have an opportunity to wear multiple hats given my recent experiences. But I wanted to first give a brief background about myself, and then I'll respectfully ask everyone of my fellow panelists to give brief introductions of themselves as well. I'm Steve Samir. I'm Senior Fellow at the Center for American Progress. I focus on the on energy policy and the energy group there. I am part-time. I'm non-resident, meaning I have always lived for the last decade plus in Silicon Valley, and before the last couple of years when I did a slight respite in DC, which I'll mention in a moment, I love being in Silicon Valley and like being in Silicon Valley. So I work for CAP as a senior fellow, but it's part-time. For policy, I also work for a private equity fund as an advisor called Lake Sumeru, where I'm helping them get into the clean tech space with investments. And I also advise about a dozen plus clean tech and internet companies out here. One of the reasons why they asked me to moderate this is that I recently concluded an appointment in the Recovery Act team for the Department of Energy in the administration. In that group, I was part of Matt Rogers' team. He was a senior advisor to Secretary Chu in the deployment of, well, the selection and the deployment of over $32 billion of grants, and we did over $25 billion of loans during that 18-month period of time. Matt had a team of senior advisors. I was one of them, where I was loan programs advisor and the chief strategic operations officer for the loan programs for the LGP program there. And before that, my background, as I inferred, was I've been in Silicon Valley since 1998. A lot of my background is in media and IT, and like most people in clean tech, we made the move within the last decade. So I'm very happy to be back. My appointment ended the end of September when I took up these new relationships with these new organizations. And I see a lot of people in the audience I've had the privilege to get to know over the last few years, and especially recently. But I'm very excited to help lead this panel with my esteemed set of colleagues here that represent some of the leading companies and leading investors in the clean tech space, both in the solar, in the wind, and then in the VC industry with Samir and Vinod and his colleagues doing over, and you'll correct me if I'm wrong, but over 70 plus investments in some of the bleeding edge clean tech companies out there. So with that, I'd like to let my panelists introduce themselves.
Hi, my name is Frank Yang, and I'm Director of Business Development for Stion. So Stion is a manufacturer of high-efficiency thin-film solar panels, and we're based here in San Jose. And so today we're scaling, shipping our initial products and scaling our mass production capabilities. So I was actually one of the first 5 people to join the company back in 2006. So over the course of the last 4 years, we've had a fairly rapid move from R&D stage all the way into product development and into manufacturing. And, you know, during this panel, Steve's asked me to talk about some of the experiences we've had both on the federal, state, and local funding level that have helped accelerate what the company's doing. A little bit about my own personal background. I'm actually originally from the East Coast, and I actually got linked up to Samir and the folks at Khosla during my time in business school, and got linked up with the founder of Stion fairly early. So as I mentioned, I've been with the company ever since we were an incubator in Menlo Park. So it's been a pretty fascinating experience, and certainly the role of federal funding and the role of the government has been a pretty significant driver in our business and in the solar industry in general.
Evelyn?
Hi, I'm Evelyn Lim, and I'm the Senior Vice President of Legal at Element Power. Element Power is a company that focuses on utility-scale wind and solar development. We have operations in Europe as well as in the United States. Our headquarters in the United States is in Portland, Oregon, and we have plants operating in Europe, and we are actually under construction in one of our first plants in the United States right now, and that's a wind farm. Prior to Element, I was the Deputy General Counsel and Senior Vice President at First Wind, and while I was there, helped raise over $2 billion of financing for the company. Part of that financing actually was a DOE loan guarantee for one of our projects in Hawaii, which I think we'll touch about later. And I think we did have some interaction with Steve while I was there. And prior to that, I was a partner at a law firm, McDermott, Will and Emery, doing finance. So that's my background.
Samir?
Samir, Kaul, I'm Managing Director at Khosla Ventures. As Steve mentioned, we're probably one of the larger cleantech funds. We do about half of our companies are cleantech and half our companies are IT, though there's probably more, the capital is probably more weighted towards cleantech. And again, like Steve, I used to be in biotech. I did graduate school on the East Coast. I'm from Washington, D.C., and worked with Craig Venter in the late 90s on the early genomic project before going to business school, and became a biotech investor in Boston for about 5 years before joining Vinod when he started Khosla, leaving Kleiner. So happy to be here.
Very good. So just so we're all on the same page of what's happened in the last couple of years, I just want to give a little context. This morning we had some great panels and great information shared, and a lot of what we talked about was the Recovery Act. But if we want to really dig deep on the clean tech sector, what was mentioned in great detail this morning was one of the premier programs, one of my personal favorites, is the ARPA-E program. But for everyone in this audience, I just want to take a couple of minutes to give you a little bit of breadth and depth of what the Recovery Act did, because ARPA-E was just $400 million of $32.7 billion of the grants, not including any of the $25 billion of loans, and there's still another $50+ billion of loans that will be deployed in the next 9 months. So very, very simply, the Recovery Act, as everyone knows, was $787 billion stimulus program. 1/3 of it was designed specifically for laying the investment and infrastructure for innovation going forward. So if you take 1/3 of that, the 32.7 plus anywhere, depending upon which point in time, $2.5 billion to $6 billion for loans, the Department of Energy had a plus or minus around $35 billion of that 787, the 1/3 of that for their efforts here. But it was not just in one program, not just for one technology, and certainly not just one set of investment vehicles. It was a whole set where the Congress, in their great intelligence, decided, in their great wisdom, decided to say that, recognize as appropriate for anyone that's in this room, that different companies are typically at different stages of their development. And it's really not appropriate to only fund one stage when there typically has not been enough investment capital in the sector to begin with. And there's typically, even when there is more investment capital, there's still what they call the valleys of death at certain unique points in that company's development. And so with that wisdom, they said, okay, we don't want to pick winners and losers. We want to let the markets determine that. We want the technologies to prove themselves out. But what we want to do is we want to have a range of programs that appropriately hit the companies at the right time in their appropriate development sector, and let everyone that is interested in applying to apply at that particular time. So there were, I believe the number was 144 different programs that the Department of Energy was asked to do solicitations for, do selections for, and do contracts, procurement, and obligate that money and then track them as they spent it. The typical period of time that these things would historically have been done was 2 to 2.5 years. The typical amount of money was $3 billion a year. That's about the average annual budget that the Department of Energy has for development and deployment as part of their about $25 billion of annual budget. So if you do the math, $3 billion to $30 billion, 2 to 2.5 million, they wanted us to do it to 6 to 9 months. So you have the numerator go up 10x, so the denominator go down by 0.25. It was overnight a 40x operational improvement that they required and respectfully requested of the Department of Energy to do. And that's what the recovery team was asked to execute on. And we did that. Over a 1.5-year period of time, we did those 144 solicitations. We gave out over more than 5,000 grant recipients, over 25,000 applications. So the nice thing is that the programs got to tell the winners and we got to tell the 82% of the losers. That was the hard part. But the great thing is that all of a sudden we had so many more people participate in the process and be able to get the process done in a much more humane, professional manner of 6 to 9 months for these various programs. So a ton of demand. Some of them, and on average it was about 5 to 6 to 1, but there were some, like ARPA-E, where I am not kidding you, the first solicitation had 3,700 to 4,000 applications for 37 winners, so less than a 1% hit rate for that one. That was an extraordinary case. On the loan side, it's slightly different, that once you make it to a certain point of are you creditworthy or not, we can actually get it to a 30 to 50% hit rate if you're at that creditworthy standpoint, but it takes 9 to 15 months. And so we got the money out. The $32.7 billion by September 30th of this past year on the grant side was fully obligated, so it was in the control. The contracts were done through procurement for access on a monthly basis by the recipients. And the recipients then were asking for that money and spending it on a monthly basis to plan, which is about a steady state of about $800 million to $1 billion per month, and that you take that out for 3 years, and that's the $32 billion of money out there. And the reason why it's not all up front is someone gets a grant, you don't want them to spend it all in 1 month and not have anything for the next 3 years. It's a business. You're given, your $2 million, your $10 million, your $50 million, in some cases your $250 million, based on what type of a project. Was it R&D? Was it the pilot? Was it the demonstration, if you're on the grant side, or if it was for the first commercial if you're on the loan side? So the funds were appropriately sized based on what the needs of that company and project were and where they were in their point of development. But the part that we're all most proud about is that for the first time ever, there was a programmatic effort to make there be what they call a cost share. On the grants, the difference between grants and loans is pretty obvious. Grants are money that goes out that's not to come back. A loan is a loan, like everyone else thinks of, money to go out that is to come back. But grants, what we did is we didn't only want to do a one-time only infusion of capital into the market, into a market that is a cornerstone of the president's administration policies, but have it to be a one-time only effort. And as everyone knows, overnight that $30+ billion made the Department of Energy, even though they're not taking equity stakes per se, essentially the largest VC in the world in the clean tech space. They didn't only want it to come from government. It was really important that not only should investors come in, but also the financial institutions outside of investors should get off the sidelines and help that industry recover as appropriate in their respective points in the market as they participate. So on average, each program had about a 50% cost share. So if I gave a $5 million grant to a company, before they could actually get that money and have that procurement contract concluded, they had to raise $5 million of private capital as well. And so that, depending on the program, was 50% in some, 30% in others, 70% in others. That $32 billion yielded more than $100 billion of capital that went into the clean tech space. And so that's the part that we were most pleased with, not because only of the capital infusion and the matching on the private sector side, but also for the immediate overnight transparency between the entrepreneur that's seeking funds and the investor that wants to give funds. Typically, historically, there's been a dance. If you're an entrepreneur, when, how long it takes, et cetera, you want to position yourself for when you're seeking funds. And on the investor side, and I don't mean to get chuckles from my panelists here on the panel, there's a dance on the investor side of who they're meeting with, what's the process, how long it's going to take, and so forth. And some of these things can take a protracted period of time. What we really wanted to do is make it completely transparent, where everyone knew who the grant recipients were. That was made public when the selections were made. Everyone knew it. And everyone knew that those recipients needed to get money in order to get the deal done. So it immediately shortcutted the entire dance so that there literally was no dance, so that it made it hopefully a much more streamlined process between entrepreneurs needing money and investors seeking places for that money to be able to consummate those transactions in hopefully a much more expeditious manner. And so those funds, those programs are now done. We're back to the base programs, which is that $3 billion. The budget for next year hasn't been agreed upon by Congress and so forth. You can just hope that there will, there'll be the continued resolution, and then ultimately that it will be approved, and that it'll be, for the most part, what it historically has been, plus or minus around $3 billion, plus having RPE, which was a new program just for the Recovery Act. So it's not part of the historical base budget, have RPE covered going forward. And as everyone heard in December with the tax extenders, that 1603, the investment tax grants, was extended one more year. So that gives projects in the renewable energy space that one more year to be able to qualify and be able to get the 30% back on the investment, the upfront investment tax grants. So from an overview standpoint, I just wanted to kind of have everyone understand what these last 2 years hopefully accomplished. And many of you in the room, I know some of the members on the panel here, were direct recipients of that, and I hope you're costing and you're spending the money as appropriate. But going forward, knowing, again, the other programs that are going on in Department of Energy and other agencies, as well as in the investor world, the different organizations that you can pull from to be able to continue to fund your efforts going forward at the appropriate point in your technology's development or your project's development. So just that's how I wanted to start. Before we actually get into the questions for the panelists here, I just wanted to take a quick check of the audience here, because I personally love to know the makeup of the audience. Usually panelists like to know who's in the audience. So I just wanted to throw out a couple of different types of backgrounds people have in the audience, and if you can just raise your hand for the one. If you're in a clean tech company right now, if you're thinking about starting a clean tech company, if you're an investor in this space, and the last one is if you're a service provider in this space. So I'm just genuinely curious from a count of hands for the first one, who currently works in the clean tech space in a company? Okay. Who's here thinking about starting a company in the space? Okay. Any investors in the audience? Okay. And then service providers. Okay, so honestly, plus or minus 5 or 6 for each answer, it seems like it's more or less an even split. So that's good. Thank you very much. So first, so that we're, again, rather than just on the government side, I'm genuinely very interested in what my panelists feel about how they view what's gone on in the sector, in the clean tech space over the last few years, and where do they think it's going for the next 5 to 10 years. If each one of my panelists could talk, obviously, about their specific sector, and I'd love it if Samir could talk from an investor's view, as well as for some of the sectors that were not covered in solar and wind. So, Frank?
Okay, great. So just to give you a little bit of a background on the solar industry, it really originated here in the United States about 30 years ago. So Arco Solar was the first solar manufacturer in the world, and then that was subsequently bought by Siemens and Shell. So if you look at the industry 10 years ago, it was vastly different than it was today. The fundamental technology that was used to manufacture panels was crystalline silicon, and the industry as a whole was producing several hundred megawatts per year. So Siemens was actually the first company to surpass 100 megawatts per year in annual manufacturing from a company standpoint. So obviously, over the last 5 or 10 years, the industry has had tremendous growth and tremendous, efficiency improvement and cost reduction. So I think one of the, foremost trends in the industry over the past 10 years, which is relevant to what Stion is working on, has been the development of advanced thin film materials and process technologies. So if you look at, thin film technologies versus silicon, the primary advantage today is that thin film, offers a much simpler production process and much lower production costs. So if you look at First Solar, who's the leading manufacturer in the industry, they were essentially sort of a hobby shop, 10 years ago, but now they're the #1 manufacturer in the industry, and they themselves produce over 2 gigawatts per year. So I think if you look at the context of the industry, that's obviously been a major change. And now Stion, is one of a number of companies that's, trying to employ more efficient materials and processes and production equipment to improve on the cost and the efficiency of the product. So if you really look at where the industry's at, today in terms of some of the key dynamics, like I said, manufacturing scale and cost reduction are two of the things that, all the major companies today are seeking. There continue to be an amazing amount of inflow of new and interesting cell and module technologies to improve. I also think if you look at the downstream area where Evelyn works, and also at some of the balance of system components, you're starting to see a lot more sophistication and scale there that you didn't see 5 or 10 years ago. And that's, I think, is really going to part of what's going to drive the growth of the industry, going forward, because you're going to get to a point where the energy prices of solar are going to be competitive to the energy prices of retail electricity, but you still need all of the infrastructure in terms of downstream installation and financing to support that. So that's an extremely important part of nurturing the manufacturing landscape. So I guess in terms of where I see it going over the next 5 to 10 years, as I mentioned, the opportunity to lower costs and increase scale is going to continue to be a big part of it. And then I also think that now, as the industry started to mature into a large-scale manufacturing industry, you're also going to see companies have the luxury of investing the time and the effort and the money into developing truly disruptive cell technologies that are going to increase efficiencies and reduce costs by an order of magnitude of where they are today. And then I think you'll expect to see the market grow accordingly. And I think last but not least, in terms of talking about the U.S.'s position in the whole market, I think maybe one of the negatives of the past 5 to 10 years is the U.S., originally dominated the manufacturing base of this industry, and today it actually produces less than 10% of the product. I think you'll see that with announcements from Stion and several other companies in the industry that this trend is already changing today, and due largely to both federal and state funding opportunities. I think you're going to see the U.S. come back on the map as a major player in manufacturing. And then I also think on the downstream side, on the installation side, you're going to see the U.S. go from being today, it's really sort of a top 3 to 5 market in the world. I would anticipate that if not 5 years from now, 10 years from now, it's going to be the largest, because I think there's a lot of demand for the product from commercial customers who consume a lot of energy. There's a lot of interest in corporate sustainability and other initiatives that drive the branding aspect of solar. And I think, like I said, the industry is professionalizing to a point where all the infrastructure and systems are in place to actually execute this. I think it's a very exciting time in the solar industry, also a very challenging time, and I think it's going to continue to be that way for the next 5 to 10 years.
Evelyn?
Okay. So I'm going to pick up a little bit on what Frank was talking about with respect to technology. I mean, wind has been around for a while, and we've seen a lot of things happen. We've seen turbines go from kilowatts to megawatt size to multi-megawatt sizes. People are now looking at offshore technology as well. And so one of the challenges that the wind industry faces is how do you get financing for some of the new technology that's out there that may not be proven. And so as you've seen through the years, when the PTC was out there, this is before the economic crisis sort of hit, and we had more tax appetite and more PTC investors. You had a lot of installations of wind projects, and it's really interesting to see if you go onto the American Wind Energy Association's website, they have these graphs that show every time there was a PTC expiration date, there is sort of a drop-off in development while people are waiting to see what the government's going to do. Because at that time, if you didn't have the PTC, it wasn't really economically feasible to build some of these commercial-scale wind projects. So developers would stop developing, or they'd put their development on hold, and then turbine manufacturers would lose some of their sub-suppliers because the sub-suppliers would start supplying other industries. And then once the PTC was renewed, even though it was grandfathered back, a lot of times you would have lost a lot of momentum on some of these installations. And that continued to happen. Then when the economic crisis happened, you lost a lot of your PTC investors just because they no longer had their tax appetite. So the ITC cash grant came along and was extended so that wind was actually one of the technologies that was eligible because previously the ITC was not available for wind. And once you saw that, there was a huge, I think, and that was partly because I was working in it, but there was a lot of increased activity with respect to developing projects because now you had a way to get cash and you could monetize that cash flow. And again, when the ITC was going to expire at the end of this year, you sort of started to see the same thing that happens when the PTC expires, which is people were either pushing really hard to meet the deadlines or meet the definitions for the safe harbors that would allow their projects to still qualify for the cash grant, or put their projects on hold and wait and see what would happen. Wind and solar, a lot of these renewable technologies are very, very capital intensive. And if you don't have a way to finance the project, unless you have a really big balance sheet player behind you, it's really hard to do. And one of the things that you were seeing in the industry a couple of years ago are a lot of the independent power producers were being bought by a lot of utilities, and most of them were European, who were trying to break into the U.S. market. And so you would see some of the smaller wind companies, independent wind companies, be bought up by Iberdrola or other larger utilities. And so it's been interesting to see the change in the environment, the change in the way that people look at financing projects, because there are fewer IPPs out there. I think that for the future, I think the big thing is going to be there are a lot of transmission constraints, and one of the issues that faces wind and solar and other intermittent technology is how do you smooth the power? How do you make it less intermittent? It's really hard for a lot of these utilities, and particularly in my experience working in Hawaii, where it's an island grid, it's a little bit older, and it's probably a little bit more sensitive to when energy falls off. Some of these utilities are more hesitant to accept bids from intermittent technologies, regardless of the fact that there are RPS standards out there in certain states. And so one of the things that First Wind had done was work with a battery energy storage company, and that was part of the whole Kahuku project that they did. And the goal there was to find a technology that would help you be able to, basically when the wind falls off, or your electricity just stops. So what they were trying to do is have it, instead of fall off suddenly, have it sort of smoothed down so that the traditional energy sources could ramp up without having a huge loss of power. Because the last thing that people want is, if you're relying on wind, let's say it's night and the wind is really blowing and your energy is being supplied by wind, the last thing you want to do is have the wind stop and have all the electricity stop and have 2 hours before your traditional turbines heat up and produce electricity. So that's one of the big challenges that I see, and I think that the programs like the DOE Loan Guarantee Program, that is, the government is willing to take the risk on some of these new technologies, and that helps show some of the lenders and other financial institutions and tax equity investors or other investors out there that these are things that can be financed and that there are risks that can be addressed. And so as we move towards that type of an atmosphere, I think it helps stimulate some interesting technology. And there was another thing that I wanted to say, and I forgot, and I'm sure I'll remember it.
You'll remember it later.
Yeah.
Samir, how's the VC industry looking?
Better than '08, but so that's good. No, in all seriousness, I think like when you get into any new industry, frankly, when we started investing in clean tech in '05 and '06, we didn't really know what we were doing. We were, biotech investors, IT investors who then would move towards something that felt comfortable. I'm a biochemist by training. I liked biofuels because I could understand a little bit, at least, on the technology. And you saw a lot of IT investors in Sand Hill Road start to invest in things in batteries and solar because there were semiconductors and materials, and they kind of got a grip on it. I think we've moved now, after 4 or 5 years of doing this, into more, not necessarily investing in what's comfortable, but what actually makes a lot more sense. And so we could talk about some of the areas outside, and I think there's still a lot of money to be made in wind and solar, but I think there are people on the panel who are much smarter about it than I am. Some of the areas that we've thought about now investing in is making things more efficient. So let's face it, oil, coal, they're going to be here forever. They're going to be here for a very long time. The question is, what percentage of our energy will be dependent on them? And are we dependent on them, or are we going to create alternatives that then the market can allow you to pick? So when I went to Brazil, it's great. You go there and you can buy either 100% ethanol or you can buy fuel that's blended with ethanol. And there's no mandates, there's nothing, it's just pick. And if you look at what that's done to Brazil, it's allowed them to become completely a net importer of oil. And that gives the country great flexibility and the consumer great flexibility into what they want to do. So I'm a big believer, I think bring it all on. Let's look at electric cars, let's look at hydrogen cars, let's look at natural gas. Just put out all kinds of, and the government's job, and I've told a lot of the folks in Washington this, should be to foster innovation across the entire spectrum. The government shouldn't pick what is the right way to go forward. Invest in everything. Look at the most promising people, most promising technologies, and then let the market pick when it comes to scale. What can compete? What are the trade-offs? Because you see sometimes if the government sets too strong a mandate one way, I think the government went very deep into electric vehicles, and I'm a fan of electric cars. But even the most optimistic estimates show that at best by 2020, 5 to 10% of the fleet will be electric. That doesn't make a difference. That doesn't solve our geopolitical issues. That doesn't solve our energy independence issues. That doesn't solve an economic crisis. It doesn't create enough jobs. But I think as a VC, we've started to look at things with those assumptions in mind. So a long way of getting to, we've looked at more efficient engines. The internal combustion engine is going to be here for a long time. If you can develop an engine that's 20 or 30% more efficient, that's 20 or 30% less oil you need to import. That's 20 to 30% less CO2 you put in the air. And it's less money out of our pocketbooks because we're filling up our gas tanks. So it's a win-win. So we've started to look at things like that. Same thing with LED lighting. If you're using 1/10 of the electricity to get the same amount of light, the less recycling, less disposal of light bulbs, that's a big deal. So we've made a couple of investments in LEDs. The other thing we've learned is that people aren't going to change behavior. So we've started to make a lot of investments in drop-in fuels. The notion that people are going to have electric charging stations everywhere, or they're going to have natural gas charging stations everywhere. I barely remember to charge my cell phone when I get home at night. God forbid I forgot to charge my Tesla. I'd be stuck on 280. It'd be a major problem for me. So we've looked much more in drop-in fuels. So, we're investors, and I'm on the board of Amherst, which went public, and it's been quite successful. It's a drop-in diesel. We have a company in Houston called Kior, which makes a renewable crude. So it looks just like any other crude, except it's actually got no sulfur because it comes from biomass as opposed to. So it's a long way of saying is that you have to kind of look broadly. It's going to be multiple solutions to every problem. There is no golden silver bullet. The incumbents are going to be active and need to buy into it. If you try to fight the incumbents, you're not going to get anywhere. And that's kind of, and we've also gotten much smarter, and Steve will probably talk about this later, about getting rid of the old notion that clean tech is capital intensive and IT is not. And I think we can talk about that later. I think by getting smarter, we've figured out ways in which we can be very capital not intensive, unintensive, especially given the size of these markets.
Good. And for me, on the later stage side, for private equity, if you take a look at the Recovery Act with that money, that was, thank you. Yes, and actually, thank you for reminding me. If we can have, feel free during the time to write questions and giving it to the volunteers, and they'll pass it to me real time. And when we get to the last 20 minutes, we'll reserve time for going through some of these audience questions. Thank you. But, with those investments that were made, that works for 2-3 years. What I'm really excited about, but I'm also a little nervous as well, is in 2-3 years, those companies that got the appropriate investments for where they were in their stage of development at that time will now be at the next stage, and they'll need capital at that point. And there won't be a Recovery Act 2.0 from the government. It must come from the private sector. And so, thank you. There are VCs out there. There are some great VCs, but as Samir mentioned, and as everyone knows here, there is a contraction in the market, and the bottom 1% is not going to be able to participate from a fund formulation standpoint going forward. So even though there are some great clean tech VCs, I still honestly, genuinely believe that there aren't enough great clean tech VCs, and there's still a gap at the BC level because there are some great ones early stage, and there's just not enough in the BC range. The nice thing is at the later stages, once technology risk has been minimized and seriously mitigated, you are now seeing some more private equity groups like Silver Lake come on board and start helping on the deployment phase. You're starting to see the tax equity markets come back. That's been particularly interesting to see in the wind space, and later we can have Evelyn talk about that. But it's also now very popular. There are some really large, very successful deals being done in the distributive PV space, solar space. And so we need more of that too, though. A lot of the initial tax equity is coming from Europe and some Asia, and we need the U.S. banks to come on board too, and that's what the loan guarantee program was all about. And so as more of those deals get done this year, because loans, unlike grants, had an extra year to do those deals because they're very complicated deals to do as opposed to grants, those will get done through September 30th of this year. You'll start seeing more and more of those later stage, first commercial, and in the mature technologies, even the full commercial deals get funded by the private markets and by the larger investors. Once you have that, I think you need to just see what happens in the next couple of years as more of these companies start coming on board and making larger and bigger plays, with the most successful ones hopefully going public this year and the first half of next year. I'm very cautiously optimistic. I think we've got 10 to 15 fantastic clean tech companies out there that'll go public in the next 12 to 18 months. My wife's an IPO partner at Wilson Sonsini, so I see the pipeline of great deals that are on the horizon here. So we'll see, but that's what's needed. For all these great technologies to actually get to the next stages, you are going to need to see the private market step up here. So we talked a little bit about the areas that you guys are most excited about, but most of you have over the last 2 years actually personally had touch points with the states and the federal government on helping you grow your businesses. In fact, even, and I'm looking at Frank here, this has been a particularly good week for you, Frank, hasn't it, for Stion? Can you tell us a little bit?
Yeah, so I'll actually just sort of walk through a little bit of all the programs that the company has worked on, and then touch on the announcements specifically that Steve mentioned. So I think if you sort of look at the solar business at a high level and where federal and state funding opportunities can help out, I think you can sort of divide it into three general areas. I think there's a lot of funding available for R&D and product development. So for solar, that's primarily managed through a branch in the government called the Solar Energy Technologies Program that encompasses the National Renewable Energy Lab and some of the other technical organizations in the DOE. I think what you're starting to see more of today is manufacturing financing, both on the federal and state level, and that's something that now Stion has started to get to the stage where it's been able to tap into. And then, like I said, last but not least, there's a very important downstream element. So if you look at the history of the industry, the reason that countries like Germany grew so quickly was that actually they used downstream pull to attract manufacturing and then built the manufacturing tax incentives around it to sort of serve it with local capacity. So I think specifically around, Stion's experiences in leveraging the federal government, the company's really sort of evolved through what I would call three distinct phases. So I think in the first phase, in the year and a half or two of the company, really sort of in a rapid iteration phase of R&D, developing and exploring a lot of different materials and device structures to figure out what our product was going to look like. Actually, for those first year and a half or 2 years, we were actually very hesitant to pursue federal R&D funding because of some of the disclosure requirements and the fear that it might compromise our IP. And those grants also relative to VC funding and later stage funding can be fairly small. Although later on, as you go into more complex product development initiatives, they can still be quite valuable. Then from sort of the 2008 to 2009 timeframe, we were really focused on going into aggressive product development on our Gen 1 and Gen 2 and getting a product to market. So during that time, we were able to leverage a $1 million grant from the city of San Jose to move into a R&D and pilot production facility there. And the city of San Jose, I think among the cities here in the Bay Area is definitely one of the more business-friendly and technology-friendly cities. So they've been able to help us get up and running to this phase, fairly quickly. And then as Steve alluded to, where we are today is we're really in this, race to scale manufacturing and then also continue to improve our cost and efficiency at the same time. So we've pursued, funding from the DOE. That's still in process, so there's some restrictions on what I can talk about there, but we are looking at the loan guarantee program and have spent, a fair amount of time on that. And then this week, we actually announced a major incentive package with the state of Mississippi to expand production in Hattiesburg, Mississippi, which is about an hour and a half north of New Orleans. So I think this is a pretty significant deal from a couple of perspectives. I think first of all, there are actually only 200 megawatt plus solar fabs, in the U.S. today, First Solar and Unisolar, and neither of those companies is actually expanding production here in the U.S. I think second of all, it sort of signals, as I mentioned, a trend to the U.S., returning to being sort of a powerful player in manufacturing and specifically incentivizing it on the state level. So I think if you look at the numbers on the deal, and I think Samir will talk about this a little bit later in relation to the business models of some of the companies. It's a very significant lever for the company in the sense that there's a $75 million loan, and then just in the first year loan, there's an additional about $12 to $15 million in upfront incentives. So obviously, if you look at the difficulty and the the equity value that you'd have to go through to get that from an equity source, it's pretty substantial. And I think if you sort of compare it to big economic development deals in other industries, if you sort of look at it on a per job created basis, is actually 1.5 or 2x more than companies like Mercedes and BMW got to build plants in places like Alabama and South Carolina. So we're obviously very excited about it. It was a lot of work, and there's a lot of detailed site selection and other factors that went into getting this done. But I think it's a significant lever for the company. And then I think the couple other programs that I'll just mention very briefly is the 48C tax credit. So that's an investment tax credit program for manufacturing equipment that's actually very similar to the program that Germany used in the early days to attract companies like First Solar. And then we continue to look at a variety of R&D funding mechanisms through the solar energy program that I mentioned. So there's a lot of different opportunities to be leveraged on the federal, state, and local levels. I think one of the interesting things from a company standpoint is that a lot of these are new programs and new approaches to doing things, as Steve mentioned. So from an entrepreneur standpoint, it's been a really fun experience because sometimes there aren't so-called experts in the field, so it's really a sort of a race to see who can work the hardest to understand it the quickest. And at the end of the day, the technology matters, but I think as an entrepreneur, there's also a lot you can do about understanding the programs and spending time in Washington and other places to really invest the energy to make this work for your company. So I think overall it's been a great positive for us on both the federal and the state and local level, and we look forward to continuing to working with all those groups to grow our business.
If we can just talk for 30 seconds or so about the Kahuku project, because I know you mentioned it earlier. And also, I wanted to first thank everyone in the audience that's been giving questions. I've been trying to multitask here and read them. So the good news is that actually amazing questions. So seriously, thank you. The bad news is that we could have done an hour and a half just on the questions that have been put forward to me in the last few minutes. So I want to quickly get through some of the outstanding questions we have planned here, and I want to get into yours. But I'm already looking at the clock, and we'll only be able to do about 10%, 15% of the questions that have been put forward. But they are truly great questions that you guys have put forward here. So let's just talk a little bit about Kahuku.
Okay, so Kahuku is a project that is being developed by First Wind, and as part of that project, they've been working very closely with the utility, who had basically expressed some concern with respect to the intermittent quality of wind. And so First Wind went and spoke to some battery manufacturers and came up with a partnership with one company. Extreme, and they are developing a 10 megawatt battery to help this project. The project itself is a 30 megawatt project. Obviously an expensive project, and it was during a challenging time in terms of raising capital, and we were also using new technology. Now, the battery technology had been around for a while, but it had never been used in conjunction with wind. And so that combination made it something that, while investors were interested in it, they weren't necessarily willing to take the risk on it. So when what we did was we actually applied for a grant, a DOE loan guarantee, actually, under the Innovative Technology Program. And we were actually one of the first projects to go through that program. Most project financings that you do for wind projects, they're relatively short term. They don't take that long. This process was an 18-month process. It was a long process. The application process was quite intense. There was a lot of information, and not very many people had gone through it before, so there were a lot of questions back and forth. And I do have to say that working with the DOE, they were really helpful. They understood that these programs were new. They understood that there were going to be some frustrations, but they were very open to listening to ways to improve it and ways to be a little bit more responsive. The negotiation of the documents was also really interesting, because you're dealing with the government and not commercial lenders who you're used to dealing with, who can take certain risks, who are willing to take certain risks. The government, although this is a program to encourage investment in innovative technology, really didn't want to take the risk. So we did have a couple of conceptual discussions with some of our team at the DOE to say, but wait, this is an innovative technology, so by definition, it's not really been proven yet. So you do have to take a little bit of the risk. And so it was an interesting negotiation. And the other thing is, it's just the way that the government thought about how the loan should work was a lot different than what we as developers had been used to. It was not always a smooth process, but at the end of the day, it allowed First Wind to get the project built. And I believe that they're pretty close to going commercial. And so that was actually something that was, I'm not sure that people are running to do it all over again, since it is a long process, but it definitely enabled them to build a project that potentially could show, ways to help smooth the power for these wind projects.
The great part about the loan program is that it really does help that later stage, the first commercial and full commercial efforts. The bad part was that there was historical baggage in the government with loan programs having been done in the DOE in the late 70s and not having them be done well, in my opinion, and there was some history there. So in this administration, as well as in the prior administration when the 2005 Act was enacted, there was a lot of concern that they learn from the 70s and not go down that path again. And so when those initial early solicitations went out, those first couple of applicants, and then those smaller, far smaller set of applicants that got through into actually due diligence to get the deal, the good part is that those early ones got the first couple of deals. The bad part is that because they had never done an application like this, it had been 30 years since the DOE had built a program like that, and they wanted to be very, very careful on this. It was a much more protracted process than either side would have liked. But the nice thing about it is that the first deal you go through a zillion issues, the next deal you go through a zillion minus a couple, and then as you do 5, 10, 15, 20 deals, one by one, you start actually litigating all the outstanding issues. You can actually crank through the system, much more quickly, still given that it's still a major loan. And so for those guys, it was 15, 18 months. For the first deal, I think it was close to 2 to 2.5 years for the first deal that went through. Now the process is 6 months for the mature technologies and plus or minus around 9 months for the innovative technologies for those that went through. So, and then Samir, from your portfolio companies, you've had an opportunity to actually have a number of them win different things. And I don't want to go much into this because I want to dive into some other questions, but if you could just mention a couple of your grants or tax credits, et cetera.
So we have, we've had quite a lot of success at the state level. So one of our companies, Kior, that I mentioned, that does biocrude, as well as another one of our companies doing electrochromic glass. These kind of companies create a lot of jobs. There's a lot of reason for the state incentives to kind of come in and help out. We've got a number of companies in the queue in the DOE and USDA loan guarantee, and we're hopeful they'll come out. And we had some companies with ARPA-E, which I think is a great program because that's really, first commercial plants are difficult to get financed, but after that they should be pretty straightforward if the technology is worth financing. What's neat about the ARPA-E is that there are very few. We have a seed fund which is meant for science projects, but there are very few funds which will take the crazy big science risk, and the ARPA-E program I think is great for that. So I actually think that's probably one of the best programs that's come out of the recent administration.
And as long as I've got you here, Samir, I did want to actually circle back and cover that topic that you initially broached earlier. Two, three questions were asked about this, and Samir and I talked about this beforehand. But a lot of people are really in the audience trying to think of, historically the baggage with going into clean tech was that it was very capital intensive. And if you didn't want to do capital intensive or you didn't have the access to the funds to do that, then you had to license your technology. And it was one or the other. And it really precluded a lot of great entrepreneurs from getting in the space, and it precluded a lot of great investors to want to be in the space too, because they just didn't have the capital to be able to put such a large percentage of their fund to the space or to that individual project. So I personally would love to know, as well as I know a number of members in the audience, what have you been seeing, Samir, in that space, and how have you been working through it and around it?
So look, I mean, if you go in, I'd say uneducated, or if you want to be capital intensive, you can go into clean tech and be capital intensive. The question is how do you go into clean tech and not be capital intensive? So there are a couple of things that are important to note. So two of the industries that have been traditionally funded by venture capital have been semiconductors and biotech. And if you look at semiconductors, it's still over $100 million to build a fab. And the market, for specialty chips and along those lines can be less than $1 billion. So when you talk about number of dollars deployed for overall market size, it's not a great ratio. But semiconductor companies have and will continue to get funded by VC. In biotech, the reason why I stopped investing in biotech is when you get to the phase 3 clinical trial, it's as capital intensive as any business you can get into, and the risk is amazing because you're talking about regulatory compliance and capital risk, and you only get one shot on goal. So if you're a biotech company, when I was doing biotech investing, I would argue with my partners that as soon as we got to, you get to phase 2 and you get someone to take you to phase 3, you could then do a public offering. At that point, you've licensed your one drug that has made it that far to a pharma company, and your fate is in their hands. No one cares what else happens. So I would argue at that point, once you license to shut the company down and give the cash to investors and wait for the royalty check if it happens, because no one really cared what happened after that. And if you looked at the biotech IPOs in the middle of the last decade, where it was kind of a hot period, the average amount of money had been raised for biotech companies from inception was over $100 million, and the average pre-money valuation was 7 years later and was around $300 million. And so that was a success case. $100 million in 7 years results in a valuation of $300 million, which is not great, does not reward risk. And in a business where you had to then license your favorite child to someone else to take to that. So there's a lot of businesses. So you take those kind of as parameters. You say, how do you get around that in clean tech? Well, one, if you look at the fuels or the power market, you're talking hundreds of billion-dollar market. The largest drug is a breast cancer drug is a $6 billion market. You're talking 100x the size of market. So you could argue that you could have at least an order of magnitude more investment to justify the same kind of return. The other thing is that you can do joint ventures that are regional. It can be a European joint venture. It can be an Asian joint venture. It can be for certain feedstocks. It can be for certain limited number of plants. But the markets are so big that even if you have to give away 5 plants in a joint venture to get it funded, the markets are infinite. That also so those are kind of the things that we've done. So couple specific examples. Frank's company, Stion. we're the largest shareholders in that company. We were the seed investors. Most solar companies in the valley have raised 5, 6, some have even raised over $1 billion before and they still aren't profitable. And so the whole solar industry gets painted as capital intensive and unable to make money. Well, Stion has raised less than $100 million and has a lot of it in the bank. And what we did, which was, wow, I'm boring. What Stion did was said, look, we'll make one product, a single junction, and we'll work with partners like TSMC on that. And we'll get capacity from TSMC. We've got a very attractive low-interest loan from the state of Mississippi, and we're talking to the DOE. So our cost of capital is very low. And so now we're talking about hundreds of megawatts at very low cost of capital. We also have a second product, which is a tandem, which hopefully will be able to compete with polysilicon at thin film costs. So again, very capital light, creative business. Another company of ours that's filed to go public, Gevo, repurposes corn ethanol plants. So as we know, corn ethanol was hyped up. Then corn prices went to $7 a bushel. Everyone hates ethanol. The corn ethanol business is in a very difficult time. But you've got a lot of stranded capital, and you can do something with it. So you can go and pick up corn ethanol plants at 10 cents on the dollar and then convert them to make higher value drop-in fuels and chemicals and be extremely capital light and address a multi-billion dollar market. So I can go on, but if you look at our companies, as we've gotten smarter, and that doesn't mean early on we definitely made mistakes, but as we've gotten smarter, we've been able to figure out how can you become capital light, whether it be through joint ventures in certain regions, whether it be through using low interest loans, or whether it be through using stranded assets. And not give up the upside of the cleantech market, which is 100x any other market we've seen in Silicon Valley. So I'll just stop there.
So we've all identified over the last 45 minutes or so a number of challenges that we think different sectors are going to have, different types of companies are going to have, different parts of the country, and even internationally. Comes back to going forward, let's just be honest. It's a tight fiscal environment. A Recovery Act type stimulus program is not going to be able to happen again in this sector. What role do you think the governments, as well as not only the federal side but also on the state side, what role do you think state and federal should play going forward? And also, if you can add this real time, are there any particular near-term hits, quick wins that the local, state, federal government could do to actually help companies at their various points in development here? So that's about 3 different questions I've combined in one. I understand that, but wanted to hit everyone here. Frank?
Okay, I think I've talked a lot about Stion-specific experiences, so I'm just going to keep it at a fairly high level. I think Samir touched on a good point, which is that the purpose of state and federal government funding in these types of industries should be to enable things that otherwise couldn't happen solely from the private sector. And certainly in our business model, we've seen a couple of examples of that. So I think that providing leverage to companies that have already somehow proven a capability, I think, is sort of the ultimate story that you're looking for. I think in terms of touch points, I think that some of the touch points are obvious. That obviously in terms of things like the loan guarantee program, you're looking to solve a big capital issue. I think in terms of things like ARPA-E, you're looking to fund technologies that aren't at the stage where they could otherwise be funded. I would say that also not to sort of miss some of the smaller things that really impact the operational aspects of the business. So I think, for example, when we looked in Mississippi, one of the key factors that allowed us to be comfortable with Mississippi was that, not only did they give us, several $1 million set aside specifically for workforce training, but they had a community college system that had done this with companies like Toyota and done this with companies like Nissan. So there's a lot of confidence that, once you build a plant, you still have to get it profitable to pay back the loan. And I think there are a lot of those, actually smaller infrastructure and, support programs on things like workforce training and education that are equally as important in terms of actually helping companies like ours. So I think that there's sort of broad things of things that government can do.
I think that a lot of the programs that are in place are really helpful in terms of encouraging innovations in technology. But I do think that one of the challenges with the just having some of the money is the tension between getting these technologies and then where it's coming from. There are a lot of foreign manufacturers now that are coming into the markets. And it's sort of interesting to see the reaction of people. People were starting to really push for Buy American and making sure that people who are applying for government money had to have everything sourced American, and that may not necessarily be the best thing for the industry, for industry growth, and it also isn't always the cheapest thing, and so it may not always encourage sort of the innovations that you're looking for. So when you have entrants into the market like developers, so as a developer, we're not the ones who are doing the manufacturing. So we go out and we look at different turbine manufacturers, we look at the technologies that'll work at the site, and we look to see which ones are going to be the most efficient and also the cheapest in a way. And those aren't always U.S. companies. And a lot of times the U.S. companies don't always have their manufacturing facilities here. So then you run into a tension of, what is okay and what's not. And I think that's something that's an interesting thing to think about. Putting things into the government programs that require people to have manufacturing facilities in the U.S. may not always necessarily result in what they're hoping for. That's just
I'm pretty consistent. I think the two things the government can do to promote innovation is, one, they need to expand the number of visas they allow for people from out of the country. I think it's insane. We continue to educate folks. I'm a second generation. My parents were immigrants from India. We lose money on every student we educate, and then we don't let them stay when they want to work here. It makes no sense. It's completely idiotic. The second thing is that I think the federal government also needs to send a signal for cleantech that the United States is going to be serious about it. There's going to be some kind of incentive for carbon, and that we're going to continue to promote it. But without it, companies, I've already seen some of our companies start to go to China and even Australia now, which are being more aggressive than the United States. Europe has always been more aggressive. But, to me, if we continue at the government continues like they are right now, loan guarantees, all these things are great. But letting talented workers leave the country because they can't stay here when they want to, and not sending a signal to the investors that they're going to go get serious about renewables is a great way to have the economy stay in a way where they need recovery.
Yeah, and I want to echo. I'm going to mention a couple of things here, but I want to echo what Samir just said on the H-1Bs. We're talking about 20,000 jobs on the H-1Bs, and unfortunately, that one issue is getting held hostage as part of the larger immigration debate. And I understand that it's a complicated, messy thing that this particular administration is really, truly working hard to try to solve. But unfortunately, they're not able to take out the H-1B issue as part of the larger fight. And it's just this can keeps getting kicked further down the road. And what they don't understand is that these simple 20,000 jobs not only could, in the near term, create 200,000 jobs, and in a couple years create potentially even a couple million jobs. It's not only that, is that those same companies, those same entrepreneurs who would otherwise want to stay here, who have every interest in wanting to stay here, are now being asked to go abroad, back to China or India. And it's not just that that's where the opportunity is for them since they're not allowed to be here. It's that those markets are now growing as fast, if not in some cases faster than here. So that's the number one thing that we need to be able to do from an education standpoint here. From a policy standpoint, there are certain things that the government's got to do. They've got to get the budget resolved. They've got to get ARPA-E as part of the base budget. They've got to get loan guarantees past September of this year to make that more programmatic. The goal is to hopefully have CETA, which is the Green Bank, it's another name for it, be officially funded and have it be a revolving fund so that it's not just an every year fight that they already have with the tax credits and the tax grants and so forth. It's that investors want to have visibility. Entrepreneurs want to have visibility. Everyone wants to have it. And with the R&D tax credits, every year it's a fight until December, until it gets approved. And it's very hard to invest in this space. It's very hard to have the guts to start a company in this space, and it's certainly hard to grow a company when you're in the space until you have better transparency and visibility there. And so that all just ties to how much commitment does not just the DC have, but also the states to this effort, because we're focusing on one side of it. The other side is not having a price on carbon is the other side. And last year was very unfortunate that there wasn't able to be the large package passed, but there are other things that I know the White House is working very hard aggressively on to try to focus on this next year that are piece by piece. And so you just have to have both sides of the equation met to be able to have the right demand, supply, pull and push. So, but the other part of it is that people in the audience need to know, and outside these audience, if you're watching this on a stream, that a lot of the onus is actually on you. One of the greatest surprises I had when I came into the administration is I had no idea about some of these organizations that are there to help you. Earlier today, you heard about some of the SBA programs. You heard about some of the tax programs from Treasury. But there are a whole host of others that are, I mean, let me just give you an example of a couple. Exim Bank, which was briefly mentioned this morning, is one I learned, whose sole job is to help you give your foreign customers loans to buy your product abroad, to help you export. That's an amazing untapped jewel that people don't know about, and if they did, they choose not to apply. OPIC, another great organization if you're on the developer side, that they just launched, they've got new fund of funds where they're actually giving investors an opportunity to start a new fund at a 0.5 to 1 ratio. So if you can raise 100 million, they'll give you 50 million on top of that to do projects, energy projects abroad. Commerce, the ITA group in Commerce is one where if you're looking to sell your product, export your product, you can actually have a commerce staff member do research on potential supplier or customers in that particular country that you want to actually export to or manufacture in, but mostly sell to. And so that's just from a staffing standpoint, that's staff that you can leverage. That's not your own. And as I mentioned, SBA going forward, now that they're able to go up to the $5 million cap, that's great, and people should seriously take advantage of it. But the last one is that, we mentioned Mississippi here as an example a couple of times here, but there are a host of other states that are very, very aggressive. There's almost an arbitrage opportunity to talk to different states, to talk about different type of incentive programs, to be able to open your next facility there and do it here in this country as opposed to do it internationally where China is bending over backwards to have you guys do projects out there. To me, this is a national security issue. It's a very, very big deal. And whether it be the government or the states, everyone's got it. The onus is on both sides to understand what's out there, but also you have to go out there and get it yourself. And I probably should have ended with that. I apologize, because there are a bunch of questions here I do want to get to in the last 10, 15 minutes. But, the last 6 minutes. But we've already covered a couple of questions that the audience already had. They want me to end promptly in 6 minutes here. That was, we already covered about 3-4 questions people asked here. I'll try to respectfully get to a couple more here. An interesting one that people had, which we haven't talked about here, and I'm not expecting my two most immediate panels here to respond because it's not in their sector, but I would be interested in Samir, which is people genuinely have an interest in nuclear. And, what do you think is the future of nuclear? Do you think it's big? Do you think it's modular? Do you think it's going to displace solar in the long term?
Again, this goes to policy being screwed up. So nuclear makes perfect sense, right? It's clean, it's cheap, and it works. The problem, obviously, is what do you do with the waste? And so we have an investment. We did an investment with Bill Gates in a company called TerraPower, and we're not even talking in the United States. We're going right to China. It'll take us 20 years to get anything permitted for nuclear here. I absolutely believe in nuclear, and just like I said in my opening, I think nuclear and solar and natural gas and clean coal and wind all make a lot of sense, and they're going to be different spots and different locations where each one makes sense. But yeah, we're Khosla Ventures. We are fans of nuclear. The two challenges is that as venture capitalists, it's hard with a discrete amount of money to make real innovations in nuclear, and then you topple on top of that it's very difficult to get nuclear plants permitted in the United States. It makes it difficult to invest in. We did this one with Bill Gates because a lot of the technology was developed, and we figured working with him, maybe you could streamline some issues abroad.
Great. Actually, there were a couple questions about China and the solar industry, and so wanted to ask Frank here if you could comment on the U.S. market position relative to China, and how does that look for innovation in the manufacturing base for the consumer going forward?
Yeah, I think today that we've gone through in the last 5 years a period where China's presence in the industry has ramped up quicker relative to any other country, especially in terms of manufacturing capacity. I guess in my seat in the industry at a company that's developing an innovative technology and scaling manufacturing here, I actually see a lot of hope for the U.S. And I think the reason is that if you look at the direction that the solar industry is heading, technologies are becoming less process intensive and more automated. So I think one of the big selling points that China has is cheap labor, and I think that's eventually not going to be as much of a factor. And I also think that if you really look at, as Steve mentioned, all the policy implications here in the U.S. and all the recovery programs try to do, that's going to hopefully sort of give us our boost of rocket fuel to become competitive. And I think last but not least, if you look at where the innovation's really coming from an R&D standpoint, that's really in the U.S. And like I said, at some point, you're going to get some truly disruptive technology that nobody foresees today is on the horizon that's going to completely transform the economics of the industry. So whether that's 3 years, 5 years, or 10 years down the line, I would bet, more strongly that the U.S. is going to have access to that innovation as opposed to China, just based on what we know about who's doing R&D and who's investing in technology development in the industry. So I think China's a formidable player in the industry, both upstream and downstream. Certainly expect them to continue that way. But I think the U.S. has a very strong place in the industry as well, and I think it's only getting stronger.
The final question I think we'll be able to get to is one where people were genuinely interested in export capabilities. We talked about some of it from the federal side, but from an industry standpoint and technologies and companies that you all see on a daily basis, which industries do you think have the most export potential out there, especially to Southeast Asia?
I guess I'll start very briefly with solar panels. So today, actually, as I mentioned, the majority of the global market is centered around Germany, Spain, Italy, and France. And the U.S. has traditionally been sort of a top 3 to 5 market. So if you look at the global market as a whole and you look at all the companies, it's actually a very export-driven industry. Now, like I said, I think that's going to change, but just based on the volume of the market, it's a 15-gigawatt market today that continues to grow at double-digit rates. So I think the export opportunity is, just going to continue to be substantial.
Yeah, I'd probably say building materials, because where construction is growing the most rapid is probably in India and China. So if I had to think of something that would make sense economically to export, it'd probably be something along those lines. Great.
Well, I wanted to thank my panelists here. It's great participation. I also want to thank the audience. The questions you put forward helped me in the last 45 minutes wrap up. But also, not only the programs that I just mentioned, but especially DOE and all their base programs, now that we've had, knock on wood, such a successful Recovery Act rollout for those selections, going forward, we have every year some great programs in each technology sector, just a smaller funding amount than during the Recovery Act, that people just need to make sure the onus is on them to go to the website, take a look at the different solicitations, take a look at the dates, and the benefit that you have of the Recovery Act is now, rather than it being 2 to 2.5 years, is that now these programs will really get done in about 4 to 8 months, depending upon the program. So you can actually put that as part of your timeline of development on your side, and couple that with financing issues that you have for funding the operations going forward. So thank you very much. I appreciated all the questions, and I appreciate your attendance today. Thank you, team.
Thanks, Steve.